So you're saying they have to look through it as a supply shock.
Can I use the transitory word?
Oh my God. Well, I think you can. I think you did. Good morning, everybody. Welcome to the latest installment of the $1 Million Question. I'm Stephen Weitzel, managing partner, Reveille Wealth Management, joined in the office today by a true legend, Mr. Bob Dahl. Bob, thank you for being here with us today.
Good to be here, Steve.
Thanks for taking some time. So, as I was telling you, this is a show we do every week, and we're talking about things that are going to help move the needle for investors. You know, sometimes we're talking markets, other times we're talking about things like tax shelters and financial planning. But with somebody of your gravitas, today we need to have a market-focused discussion.
Sounds like a plan.
So let's dive in here. Thank you, everybody, for joining us. So, Bob, let's start off. Tell me, what do investors need to make of this global market right now?
They need to say, wow.
Yes.
And take a pause. I mean, if you told anybody on January 1st there was going to be a big war in the Middle East, oil's going to be $100 a barrel, and the stock market's going to be at an all-time high, they'd look at you cross-eyed.
Yeah.
What are you smoking?
Yeah. I saw in an interview that President Trump did and everything was going so well, you know, kind of January, February. We had a pretty pronounced rotation that was happening. Tech was weak. And then he said that he went and had a conversation with Scott Bessent, Howard Lutnick, and he said, look, we're going to have this conflict over here in the Middle East, so kind of buckle up. And he thought that the market would have gone down even more than it did.
Yep.
He thought that oil might have gone to 200.
Yep.
And I imagine if this type of conflict would have happened prior to the financial crisis,
oh my goodness.
I mean, when the Iraq War was still going on, then we probably would have gotten there.
No question. Of course, you have to ask, well, then why? How does the stock market go there? And you know the answer. Earnings. As you know, on January 1st, the expectation for first quarter earnings up 14%. We're just about done, and it's double that, 28, 29%. It's
wow.
Incredible.
Now, do we need to be concerned about peak earnings?
Yeah.
Is it a peak earnings question?
So it's not only to be concerned about peak earnings, it's peak earnings revisions.
Okay. Explain that.
Historically, when earnings estimates are moving up, not earnings estimates, and the Fed is sitting on their hands or lowering rates, stocks always go up. And that's been the explanation.
Yeah.
So you got to watch both of those things. To take the one you just brought up, overnight, AVGO, a little disappointing earnings.
Yep.
Is that the beginning of something? I think not, but we got to watch it very carefully.
Yeah.
If earnings estimates not go down, if they stop going up at these valuation levels, stocks at a minimum will take a pause.
Do you think that a lot of companies that have been investing substantial amounts of money in the AI build out, and they still don't actually know what the economics look like on the other side of that?
Right.
And we've seen from companies like Google that they hit their AI CapEx budget for the entire year in the first quarter.
Yep.
And now maybe they're going to raise another 80 billion
yep.
to be able to throw on top of it. But I saw a stat this morning that said that the only company that's actually profitable on their AI spend right now is Amazon.
I believe it.
Everybody else is losing money. So if people are losing money on it, how much longer can they continue to plow resources into that?
As long as they think they're eventually going to make good money on it. And that's where they are. And it's not only are they going to make money on it, it's where they're going to get the money to make the investments. I mean, you remember a year ago it was, we'll just raise more equity, as Google has just done. But for a lot of companies, they don't have necessarily that flexibility. First, it was, we'll raise equity. Then it was, we'll raise fixed income money. And then it was, we'll do it out of cash. And you probably remember last September, the Oracle deal with OpenAI
Oh yeah.
is
Oh yeah.
trust us, we'll find the money.
Correct. Yeah.
So
We've
I think
documented that one well here.
I think we have to watch the ability of these companies to finance this very, very carefully. I'm not a bear, but I'm
Yeah.
just saying watch it very carefully.
No, we have documented that that saga with NVIDIA, Oracle, OpenAI, and how the investors in the private credit space, they may be the ones holding the bag if those earnings and that cash doesn't come to fruition to allow for those payments to be made. Somebody's going to be on the hold for it. So
and you're right on private credit. I mean, we all know the cockroach theory. You see,
Yeah.
one, there are more to come. Jamie Dimon, of course, coined that phrase. We're not necessarily concerned about private credit systemically, but there are a lot more private credit problems out there.
yeah,
I'm not saying don't own private credit, but if you do, know your credit, and in addition, know your credit.
Yeah, 100%. So we know that that private credit, it could be a problem, whether it's a significant problem, little s, or a systemic problem, big S. But as far as the stock market is concerned, what areas of the market do you think are most susceptible to some sort of a downside risk right now?
So we've obviously seen some of that in the private credit specific companies
Yes.
where they've really struggled.
The Blue Owls of the world,
Blackstone,
Yep.
where they've had to, in some cases, put up a gate for the money going out the door. We have been, I manage, among other things, a long short product. We've been short those kinds of stocks and long the big banks as a pair trade.
Okay.
As you know, a lot of the lending this cycle has not taken place inside the bank.
Off the balance sheet, right?
Off the balance sheet elsewhere. And so when credit problems come, they're more likely to come in the elsewhere than in the big banks. Not that the big banks aren't going to have some credit problems. They will. But that differentiation we think is really important. So which kinds of companies? Look, if there are private credit problems, and they move from small s to some version of big S, the market's going to have a problem.
Yeah.
If they stay isolated, just don't own those companies, but support the ones that are not using that to finance the good growth we're seeing. And a lot of it, of course, relates to how lower end consumers can access money. And if that spigot gets turned off a bit, that becomes a problem, because more and more low income and now mid income people are spending more than they're earning. And that can only last so long, but they have to have access to credit.
So you're thinking that the risks are still in those industries that are involved in the private credit space?
Yeah, I'll add to that the conversation we were having earlier, and that is the big tech companies that have gone up 5, 6, 8, 10-fold. Some of them are extended.
Yeah.
I'm not sure they all are, but I've been feeding in the market, letting them have every day for the last month or so some semiconductors.
Yeah.
I'm not out of semiconductors. I want to get out of semiconductors. They're needed, but these runs from, let me pick on Intel, going from 20 to 120.
Yeah.
Really?
Yeah.
So let a little go. Be a little careful there.
Sure. I mean, it's amazing how much goodwill has gotten imputed on these names in such a short period of time, that the investors were clearly off sides earlier with a name like Intel at 20. But now it's gotten very crowded.
Yes.
And maybe the truth is somewhere in between.
Yes.
But probably not the time to be coming into those names guns a-blazing right now.
Yes. And or just be more specific and more careful and more, about which ones you own. NVIDIA, the biggest, the most visible, and in some ways the most forward-looking and best. That stock's only has a PE in the 20s, the mid 20s.
Let me ask you this. So, and I talked about this on the show a couple weeks ago, that what's a little bit of a red flag to me is that when I'm looking at the market's reaction to certain news, that NVIDIA's numbers were phenomenal.
Yes, they were.
The stock could not advance on phenomenal news. Is that a red flag? To me, a stock that cannot move up on good news, an earnings beat, the guidance seemed to be extraordinary. If it can advance, is that a tell that maybe the move is over?
It certainly tells us that we need a pause, and it's not like Nvidia. We're getting a pause. It's been
We've had a
sideways
pause
for a
for,
long time now,
8, 9
months
months. Yeah.
exactly. Um, and I think because there are more and more evidence of that in the market as a whole, and again, as we mentioned before we started recording, the deteriorating breadth. Yeah, the market's tired. It's really tired. I have a little stat here.
Yeah.
The last 8 weeks prior to this week, the market had its 9th strongest 8-week period, up 18%. 3 and 6 months later, the market in the better 8 periods was always up. And the average 6-month gain was 11%.
So the strength begets strength, right?
Correct.
But here, I want to throw this up. When we're talking about this deteriorating breadth here, and so this chart comes to us from our friend Andrew Thrasher, that even though we saw the S&P trade up to a new all-time high, you've got close to 10% of S&P constituents that were trading at a 52-week low.
Yes.
And that is something that we have not seen very frequently. But when we do, it's kind of emblematic of, maybe the market has gotten exhausted here.
Yes. Let me throw another one at the listeners. The S&P 500, 9% above its 50-day moving average. That's a big gap.
Yeah.
While that's happened, the number of stocks above their moving averages has moved from over 60 to under 40. So the market is narrowing. The market's tired, to use that non-technical phrase.
Sure.
And tired markets sometimes just take a rest and go sideways. Yep. Sometimes there's a bit of a pullback. And what gets hit the hardest, even if the market's sideways, typically are the ones that have been up the most.
Sure. And so those corrections can either take place through price, they can take place through time.
Yes.
Better if maybe they take place through time. If as an investor you don't want to see that kind of drawdown, but maybe those are things that people need to be aware of today. So, all right, let's talk about where are the opportunities. What is undervalued in this market today?
So I like the financials. We touched on them a minute ago. The big banks, their valuation, PEs, let's say, are not expensive relative to the market. In fact, they're cheap. 2, to repeat, they don't have as many bad loans as is typical because the lending's taking place outside the banking system.
Yep.
3, they're the biggest beneficiary of deregulation. And deregulation is happening at a rapid clip, as you know. We don't hear about it because there's so much else to talk about in the news. So I put all that together and I say, these stocks have lagged for good reasons. They were up a lot. Yield curve is flattening out. Short-term interest rates have moved up some. So there are good reasons why the banks have been sloppy, but I want to add to them here.
Okay. So financials, maybe the worst performing sector in the market this year.
Healthcare
also down, right? Yep. But we typically don't have sustainable bull markets without financials.
Bingo.
And so if this market's going to have staying power,
financials have to come on.
We've got to see some rotation into those names. Yes. So, all right. So you like financials. You mentioned healthcare as well. You like healthcare here?
Healthcare is, poked its nose up a little bit in the last couple of weeks. We're looking hard. I mean, we own a little biotech. We own a bit of pharma, but we're underweight the sector and probably going to stay there. If the market's going to pause and go down in correction phase, healthcare will go down less. I'm convinced of that.
Okay.
But as long as the bull market is still intact, healthcare, scratch your head.
Okay. All right. Let's talk a little bit about the bond market. Kevin Warsh coming in as the new FOMC chair. What do people need to know about a Kevin Warsh-led Federal Reserve?
Yeah. So I think what we have to observe is, one, he is one of only a double-digit number of people around the table who vote on interest rates. Yes, he's the chair. Yes, he will chair the meeting. Yes, he will make the most noise,
but it's not his unilateral decision.
It's not his call. And then with inflation being problematic for oil and some other reasons, I think it's very unlikely the Fed will have an excuse to lower rates. So he's going to spend his time, in my judgment, on the balance sheet, which needs some work.
Okay.
A lot less sexy to talk about,
yep.
but very important. And the balance sheet of the Fed's gotten way too big. He's got to rein that back in. But I think he will be able to keep the Fed from raising rates.
So you think that maybe efforts at shrinking the balance sheet versus raising interest rates is going to be his philosophy for how to keep the money supply under control?
I think that's right. Look, when you have, as we've had with oil, a supply problem that's caused inflation, that is not historically a good time to raise interest rates.
No.
It can be absolutely the worst thing to do.
Now, the market, though, is telling us, and we were speaking about it before we came in here today, that the front end of the Treasury curve, really a great tell for where Fed funds is likely to be in the future. The yield on the 12-month bill is around 3.8 right now, which to me suggests in the next 12 months, we're getting one interest rate hike.
If we stay at 3.8, I agree with you.
Okay.
Our hope is that the Strait of Hormuz will get opened.
Yep.
That 3.8 as a result will come down such the Fed doesn't have to raise rates. Let's be technical for a second. They right now have a dovish bias. This next meeting, they've got to go to neutral. Some would argue they may go to a hawkish bias. I hope they don't. I hope they take 2 meetings to do that, because I don't want them to raise rates. I don't want them to have to raise rates. It would not be great for the economy, awful for the stock market.
Yeah, and so, but can they sit idly by and remain neutral when the CPI reports that are going to be coming in are going to be 6% annualized numbers?
Yeah, if that continues for multiple months, you're absolutely right.
So you're saying they have to look through it as a supply shock.
Can I use the transitory word?
Oh my God. Well, I think you can. I think you did. And listen, this one may be more transitory than other pressures.
Yes.
That we've seen in the past.
Having said that, let me be clear. We don't think inflation is going to the Fed's 2% target, not without a recession.
Do we think that the Fed eventually has to amend that 2%?
You got that
objective,
right, but they dare not do it in this environment. They'll lose all their credibility. They'll have to do it at a period.
What credibility they have left, right?
Well, well said, Steve.
Yeah. All right. Let's pivot our conversation and let's talk a little bit about investing globally.
Yeah.
How much of somebody's portfolio should they consider allocating ex-US?
Yeah. Let me put that in a context, if I might. A lot of people think people have been pounding the table for international for years and years and years. Some people have, because international is cheap relative to the US. I do these silly 10 predictions every year, and one last year was international would outperform the US. We never dreamt it by 20 percentage points. It was huge.
Yeah.
And the change and the reason international makes more sense is the earnings comparisons are a lot less unfavorable for overseas. Valuations are still cheap. You and I both know cheap does not mean you have to own it.
Correct.
Cheap is not a timing tool. It just tells you the magnitude if there's something to cause it to happen. So we repeated that prediction for this year.
Okay.
If so, be the first time in 20 years that international beat the US for 2 years in a row. Then the war comes in and the dollar moves up and people move to a safe haven. International underperforms for a bit. If and as we're able to open the Strait of Hormuz and at least settle that part of the Middle East conflict, I think international will come on nicely. So to your question, my view is 20% is a good target. For
20% is a good target.
20% of equities.
And I would say that is probably substantially higher than where a lot of people have their allocation to foreign markets.
So true. When I asked people after last year, how much did international beat the US? By a few percent. That tells me how little they have international.
Yeah, they just don't have their finger on the pulse there.
Correct.
So, we've been very bullish on foreign markets here for a couple of years now. And some of the things that we've been looking at, we've got on the screen here. We're looking at the EFA index, taking out those former 2007 highs last year.
Yes.
And same thing in the emerging market space, that where you said cheap doesn't always mean you buy it just because it's cheap. It could be cheap for a reason. But I think now you actually have a technical backdrop that supports that you're going to get flows in here. So really for the entirety of 2026, this breakout in emerging markets in particular is one that we have been focused on. And this pullback to those prior 2007 highs, I couch that as a mulligan for investors. To me, it reminds me very much of the secular breakout that we saw in S&Ps in the spring of 2013.
Yes.
They hadn't gone anywhere
Correct.
for 13 years.
Correct.
We break out those former highs around 1560 on the S&P. We trade to about 1690. It looks like we're off to the races. I don't know exactly what it was. I think it might have been Ben Bernanke made some comment about, raising interest rates. That's when we had the taper tantrum in 2013. Markets get hammered by 8-9% pretty quickly. We come back down to those former highs and we dig in and we're off to the races.
This is very similar.
I think it's very similar. I think it's very reminiscent.
You guys are onto it, and I applaud you for it. And let me add 2 points to your good analysis. One, if planet Earth is going to grow, the emerging market consumers got to be the leader, because most of the developed world populations are flattening out.
Yeah.
Look at the U.S.
True.
Look at obviously
Europe,
Japan going the wrong direction. Lots of places in Europe. So emerging market consumers have to be what gets us there. My other point is, and we have a president who wants a lower dollar. That's pretty rare.
Yeah.
And
he's trying to bring manufacturing back on shore,
Correct.
right? And to be competitive, we've got to have a weaker dollar, right? As long as the Dixie is below 100, I think that could be fuel.
I agree.
For those foreign markets.
I agree. So you've got to. Too many people are 0, 1, or 2% international. Go to at least 10. If you can get to 20, we're on the same page.
Let's I want to end here with the real $1 million question, Bob, for the audience. How far away is the next recession? And what do people need to do about it?
Yeah. So I'd start by saying we will have another recession. I promise you. But I have no idea when. We do know, back to the bull market, its linchpins are raising earnings estimates and a Fed that's behaving itself. Those things won't last forever. The consumer is being tapped out a bit. We talked about lower income and some middle income consumers. My guess is, especially, and maybe conditional on oil prices coming down, this is a mid-cycle slowdown that's in front of us, not the onset of the next recession. We'll get another one. What'll cause it? Recessions and bull markets happen. Bull markets end and recessions begin not because there's an old age problem. It's they get murdered. Yeah. Bull markets get murdered typically by a Fed that has to raise rates because of inflation. Watch it carefully.
So do you think I could make the argument, and I want to look at this chart of the Russell 2000, when we haven't had a recessionary print since COVID?
Correct.
Right?
And that was a man-made recession.
Correct. And now we amended the rules so we didn't have to consider the two consecutive quarters of economic contraction. And we really didn't have a recession in 2022, but maybe the economists, at least some of them, would agree that possibly we did. But we've got the Russell 2000 that made no progress for 5.5 years. I'm going to say there's been some recession here along the way. Now, maybe it was an earnings recession, but as concerned as we might be about the consumer, about the debt levels that are out there, this is, again, one of those breakouts that if the market was on the verge of crashing, broadly speaking.
Yes, this would not be happening.
I don't think we're seeing Russell 2000s break out to new all-time highs.
I agree with you. Let me throw some cold water on this.
Okay, please.
Small stocks, as you know, typically do best when we're coming out of a recession. They have leverage to the economy, leverage to interest rates. Neither of those conditions are there. Russell 2000, 40% of the companies are still losing money. That doesn't attract me to an area.
Yeah.
I think, and also when you look at what's happening with oil prices, you connect that to the dollar and so on. I want some small cap. I want some 2000 exposure, but I don't want to overdo it yet.
Okay. The last thing I'll say here, even though we've got a large percentage of the companies within the Russell 2000 that are losing money, there's 3 very large companies that are losing money that are about to come to market
Yes.
with trillion-dollar valuations.
So well said.
Maybe these earnings are not all that they're cracked up to be. So anyhow, Bob, thank you so much for taking the time to join us here
Thanks for the opportunity.
at the $1 Million Question. Thank you, everybody, for tuning in and joining us. We appreciate you tuning in. Got to meet a few of you here over the last couple of days as I was out traveling. We appreciate all of the kind words and remarks. If you have questions about things that you're dealing with as a financial advisor, as an investor, always feel free to shoot us an email to info@reveillewealth.com. We'd love to be able to help you how we can. If you want a copy of the slides that we reviewed today, also happy to share those with you as well. But listen, we've been blessed with an investment legend, Bob Dahl, today. Hope you enjoyed. Appreciate you tuning in again, and we'll see you next Thursday right here on the $1 Million Question. Take care.